Europe seized $105 billion from Russia to fund Ukraine. Russia nationalized $120 billion in European corporate assets. Siemens, Volkswagen, Shell, 30 years of investment gone. And that was just the opening move. I want to show you how Europe just committed one of the most catastrophic strategic blunders in modern economic history. Not because the idea was wrong in principle, but because they fundamentally misunderstood who had more to lose. They thought they were wielding a financial weapon. Instead, they handed Russia a roadmap for destroying European economic credibility, and Russia didn't just follow the roadmap, they improved it. Let me take you back to February 2024. Brussels was under enormous pressure. The war in Ukraine was grinding through its third year. Ukraine needed money. European voters were growing tired of writing checks. And someone in Brussels had what seemed like a brilliant idea. Russia has $105 billion in assets frozen in European financial institutions, central bank reserves, sovereign wealth fund holdings, investment accounts just sitting there. Why not seize them, use them to fund Ukraine, punish Russia, solve the funding problem? No domestic tax increases needed. The legal justification was creative, to put it diplomatically. Freezing assets during conflict is standard. Actually confiscating them and transferring ownership, that's unprecedented for a major economy sovereign reserves. But European lawyers found a pathway. The announcement came in March 2024. $105 billion in Russian state assets would be seized and transferred to Ukraine for reconstruction. The initial reaction was triumphant. European leaders called it innovative economic statecraft. Financial newspapers praised the boldness. Ukraine celebrated. The narrative was simple. Russia will pay for its own war with money it can't defend. And for about 2 weeks, it looked like a masterstroke. Then Moscow responded, not with angry statements or diplomatic protests, with 3 moves so calculated, so devastating, that European finance ministers are still trying to understand what hit them. Move 1, Russia announced the nationalization of all European corporate assets on Russian territory. Not suspension of operations, not temporary seizure, permanent nationalization. The value $120 billion more than Europe had seized. Let me make this concrete because the human cost gets lost in aggregate numbers. Volkswagen had been operating in Russia since the 1990s. They built factories, developed supply chains, trained workers, invested billions. In some Russian cities, VW plants were the largest employers. 30 years of patient investment, thousands of jobs created, relationships built, all of it gone. The Russian government took the factories, the equipment, the intellectual property. Volkswagen's Russian subsidiary simply ceased to exist as a German company. Siemens faced the same fate. They'd installed power infrastructure across Russia, built rail systems, supplied industrial equipment. Russia didn't just take the physical assets. They took the maintenance contracts, the spare parts inventory, the service agreements. Decades of market position eliminated overnight. Shell was even worse. They had major stakes in Russian energy projects. Sakhalin 2, Arctic LNG, joint ventures with Gazprom worth tens of billions. Russia nationalized every foreign share. Shell went from equity partner to nothing without receiving a single ruble in compensation. And it wasn't just the big names. Hundreds of European companies, from mid-sized manufacturers to service providers, discovered their Russian operations had been confiscated. Danone lost dairy plants, Carlsberg lost breweries, Auchan lost retail operations. The list went on. Every European company that had invested in Russia over 3 decades woke up to find their assets belonged to someone else. The immediate corporate losses were staggering, but the strategic consequences were worse because Russia didn't keep those assets idle. They sold them to Chinese companies at massive discounts. Think about what that means. European firms spent 30 years building market share in Russia, understanding local customers, developing distribution networks, training workforces. That knowledge, that market position, it can't be rebuilt quickly. It represents competitive advantage earned through decades of patient investment. Russia handed all of it to Chinese competitors for a fraction of its real value. Volkswagen's Russian market share didn't evaporate. It transferred to Chinese automakers who bought the factories and kept producing. Shell's energy projects didn't stop. They continued under Chinese ownership. Siemens's contracts didn't get canceled. Chinese industrial firms took them over. Europe lost 30 years of investment and market position. China gained it in months, but Russia's retaliation didn't stop with nationalization. Move 2 was subtler, but potentially more damaging long term. Russia announced that all energy exports, all commodity sales would only be settled in rubles or yuan, no euros accepted, period. Now, you might think this would isolate Russia from global trade. Europe assumed it would. The entire Western financial system runs on dollars and euros. If Russia rejected euros, surely their customers would refuse to deal in rubles. Surely India, China, Turkey, the major buyers of Russian energy, would demand traditional currency settlements. They didn't refuse. They quietly switched. India set up ruble-rupee payment mechanisms. China was already using yuan for Russian transactions and expanded it. Turkey created similar bilateral arrangements. Within months, Russia was conducting the majority of its international trade without touching euros. The practical implication, Europe's economic sanctions, which depended on Russia needing access to euro-denominated finance, became far less effective. The leverage evaporated, but the signal to the world was even more significant. If Russia can trade with major economies without using Western currencies, what does that say about dollar and euro dominance? What does it say about the necessity of the Western financial system? The answer was becoming uncomfortable. It's optional, not ideal perhaps, but absolutely optional for countries willing to create alternatives. Then came Move 3, and this is the one that keeps European central bankers awake at night. Russia, together with BRICS partners, announced the creation of a $150 billion BRICS Plus Reserve Fund. The explicit purpose provides seizure-proof custody for member counts' reserves. Let me explain why this matters. Central banks hold foreign reserves for trade settlement and crisis management. Traditionally, those reserves are held in dollars and euros because they're liquid, stable, and accepted everywhere. But those reserves are held in Western financial institutions, New York banks, London clearing houses, Frankfurt accounts, which means they can be frozen or seized if Western governments decide to do so. Russia demonstrated this vulnerability. One day your reserves are accessible, the next day they're frozen, the day after that they're confiscated and given to someone else. For any country watching, the lesson was terrifying. Your reserves are only yours until a Western government decides they're not. The BRICS Plus Reserve Fund offers an alternative held outside Western jurisdiction, structured specifically to be seizure-proof, not denominated in dollars or euros. For countries worried about Western financial weaponization, it's exactly what they needed. And within weeks of the announcement, dozens of nations quietly began exploring participation. Saudi Arabia inquired about joining, not because they're anti-Western, because they have $600 billion in reserves, and they just watched $105 billion get confiscated from another major oil exporter. If it can happen to Russia, why not to them? What if a future U.S. administration decides Saudi oil policy isn't aligned with American interests? Can they wake up one morning to find their reserves seized? Singapore, one of the world's most sophisticated financial centers, started asking the same questions. Their entire business model depends on being a safe, neutral haven for international capital. But if Western financial systems seize sovereign reserves based on political decisions as anywhere truly safe, they began diversifying. Even Switzerland, the original neutral financial haven, faced questions. Swiss banks held some of the frozen Russian assets. The Swiss government participated in the sanctions regime. For centuries, Switzerland's value proposition was absolute neutrality and discretion. That reputation took a hit. If Switzerland freezes Russian central bank reserves, what does Swiss neutrality mean? The capital flight started almost immediately. Not dramatic sell-offs that make headlines, quiet portfolio adjustments, reserve managers in Riyadh, Abu Dhabi, Beijing, Singapore. They started reducing euro allocations not to zero, but from maybe 20% of reserves to 15%, from 15% to 10%, measured as percentages. It seems small, measured in absolute terms. We're talking hundreds of billions moving out of euro-denominated assets. And when that much capital moves, effects ripple through the system. Euro depreciated despite European central bank intervention. Borrowing costs for EU governments increased as demand for their bonds softened. The spread between German bonds and U.S. Treasuries widened. These movements are subtle, but they matter. They represent the slow erosion of the euro's status as a preferred reserve currency. Let me connect what Europe actually accomplished with this $1.5 billion seizure. They funded Ukraine for perhaps 1 year. That's the benefit, the costs. European companies lost 120 billion in physical assets and 30 years of market position in Russia. The euro's credibility as a reserve currency was damaged. China gained massive market share in Russia at discount prices. Dozens of countries began actively seeking alternatives to Western financial systems. The strategic calculation was catastrophic. Europe assumed Russia needed access to European finance more than Europe needed Russian goodwill and market access. They were wrong. Russia has China, Russia has India, Russia has commodity exports that the world needs regardless of currency. Europe had corporations with massive sunk costs in Russia and a currency whose value depends on global trust. And here's what makes this so frustrating from an economic standpoint. The people making the decision weren't stupid. They understood finance, they knew the risks, but they made a political calculation that overrode economic logic. The domestic politics of being seen to punish Russia was more important than the long-term consequences of weaponizing financial systems, because once you weaponize finance, once every country in the world adjusts their behavior, they don't trust your assurances that it was a special case. They don't believe you when you say their reserves are safe. They saw what happened to Russia and they prepare. This isn't about defending Russia's invasion of Ukraine. That's a separate moral and political question. This is about whether the tool Europe used was smart, whether the costs were worth the benefits. And the answer, looking at the economic fallout, is clearly no. I want to be specific about the corporate devastation because these companies have names, histories, people whose lives were affected. Volkswagen's Russian operations employed 15,000 people directly. Add suppliers, and you're looking at tens of thousands of jobs. Those Russian workers didn't invade Ukraine. They assembled cars. When their German employer lost the company, they lost their jobs or were transferred to Chinese ownership. The human cost of these economic weapons isn't abstract. For Volkswagen shareholders, the write-off was massive. For Volkswagen workers in Germany, it meant reduced profitability and potentially job insecurity back home. For Volkswagen's competitive position globally, it meant losing a major market to Chinese competitors who now have the infrastructure VW built. Shell's situation was arguably worse because energy assets take decades to develop, finding reserves, negotiating agreements, building extraction infrastructure. You can't replace that quickly. Shell didn't just lose profit streams. They lost future production they'd planned business strategy around. And those reserves didn't disappear. They're still being extracted just by Chinese companies. Now, the irony is that this was entirely predictable. When you seize someone's assets, they seize yours. It's not complex strategy, it's basic reciprocity. But European decision makers seemed genuinely surprised by Russia's response, as if they expected Russia to accept $105 billion in losses without retaliation. This reveals something troubling about European strategic thinking. They'd become so accustomed to dealing with countries that couldn't retaliate effectively that they forgot what happens when you fight someone who can hit back. Russia isn't a small economy dependent on Western goodwill. It's a major commodity exporter with powerful friends. It had options. Europe seems to have forgotten that. The geopolitical realignment this triggered is still unfolding. The BRICS Plus Reserve Fund isn't just about reserves. It's about creating parallel financial infrastructure outside Western control, payment systems, clearing mechanisms, credit arrangements. Every piece of infrastructure reduces dependence on Western systems. China emerged as the massive winner in all of this. They gained corporate assets in Russia at discounts. They positioned the yuan as an alternative settlement currency. They lead the BRICS Plus initiatives that dozens of countries are now joining. The Belt and Road Initiative just got an enormous boost because China can now offer financial alternatives to countries worried about Western sanctions, and the timing couldn't be worse for Europe. Is already struggling with energy costs post-Ukraine war. Industrial competitiveness is declining. Germany, Europe's economic engine, is facing potential deindustrialization. And now, on top of all that, European companies just lost a massive market, and European finance lost credibility as a safe haven. The lesson the world learned wasn't the one Europe intended to teach. Europe wanted to demonstrate that invading neighbors has economic consequences. What the world actually learned was that holding reserves in Western financial systems exposes you to politically motivated confiscation. Those are very different lessons. Saudi Arabia is now negotiating oil sales in yuan. That was unthinkable 5 years ago. The petrodollar system, where oil globally was priced in dollars, was a cornerstone of dollar dominance. If oil transactions move to other currencies, dollar demand decreases, dollar value decreases, US borrowing costs increase. Europe's asset seizure didn't just hurt the euro, it's contributing to the slow erosion of the entire Western financial architecture. The strategic blunder wasn't seizing Russian assets per se. It was doing it without considering second-order effects, without asking what Russia would do in response, without modeling how other countries would react, without considering whether $15 billion in short-term funding was worth permanent damage to financial system credibility. This is economic policymaking driven by political necessity rather than strategic thinking, and the costs are being paid not by the politicians who made the decision, but by European companies, European workers, and European financial credibility. I don't know if there was a better option available to Europe in supporting Ukraine. Maybe there wasn't. Maybe every choice was bad, and this seemed least bad politically. But if this was the best option, that tells you something troubling about Europe's strategic position, that the best they could do was trigger massive corporate losses and financial system credibility damage for 1 year of Ukraine funding. The real tragedy is that this wasn't necessary. Europe could have funded Ukraine through traditional budget mechanisms, tax increases, spending cuts, bond issuance, all painful politically. But none of them would have triggered Russian retaliation or global loss of confidence in European finance. They chose the path that seemed politically easy in the short term, and it's costing them enormously in the long term. Russia didn't just respond to Europe's economic warfare, they taught a masterclass in it. And the lesson isn't for Europe alone, it's for every country watching. The era of Western financial dominance isn't ending because of Russian strength. It's ending because Western powers are demonstrating that the system can't be trusted, and dozens of countries are drawing the obvious conclusion: build alternatives, diversify, reduce dependence. This is how empires end, not with dramatic collapse, but with steady erosion of the mechanisms that made them dominant. The $105 billion seizure will be studied for decades as a case study in strategic miscalculation. Europe thought they were punishing Russia, they were actually destroying their own credibility. Let me show you exactly how the financial infrastructure alternative is developing, because this isn't theoretical future planning. This is happening now. The SWIFT system, which handles international bank messaging and enables cross-border payments, has been the backbone of global finance for 50 years. Russia was partially cut off from SWIFT in 2022. Initially, this seemed devastating. How do you conduct international trade without SWIFT? Russia had an answer ready. SPFS, their domestic alternative, had been under development since 2014, when Crimea sanctions first threatened SWIFT access. By 2024, SPFS had over 500 participants, including banks from 20 countries. China's CIS system, an alternative to SWIFT for UN transactions, integrated with SPFS. Suddenly, Russia and China could conduct trade completely outside Western financial infrastructure. The volume of transactions on these alternative systems is growing exponentially. In 2022, maybe 10% of Russian international trade settled outside SWIFT. By late 2024, that figure exceeded 60%. And it's not just Russia using these alternatives. Turkish banks are connected, Indian banks are connected, Central Asian republics, Middle Eastern nations, African countries exploring connection. Why does this matter beyond Russia? Because every country that connects to alternative payment systems reduces their dependence on Western-controlled infrastructure. And that dependence was the source of Western financial power. If you need SWIFT to trade, you need Western approval. If you don't need SWIFT, Western approval becomes optional. The European Central Bank understands this threat. Internal documents show they're modeling scenarios where the euro loses 20–30% of its reserve currency share over the next decade. Less demand for euros means lower value, means higher import costs. Higher costs mean inflation or reduced consumption. European living standards decline. And there's no easy policy response. Reserve currency status isn't about interest rates or monetary policy, it's about trust. Europe broke that trust. You can't restore it with press releases. Let me walk through how capital flight works. You're a reserve manager for Saudi Central Bank, $600 billion in reserves, 20% in euros. After watching Europe seize Russian reserves, you're uncomfortable. You don't sell everything immediately. As Eurobonds mature, you reinvest 80% in euros, shift 20% to gold or yuan. Quiet, gradual. But multiply this across dozens of central banks and sovereign wealth funds, European bond auctions become less oversubscribed. The EU needs higher yields to attract buyers. Higher yields mean higher borrowing costs. Higher costs mean either higher taxes or reduced spending. Growth slows. This is already visible. German bond yields relative to U.S. treasuries have widened from basically 0 to 40 to 50 basis points on Germany's $2 trillion debt. That's billions, in additional annual interest costs. The corporate sector is drawing conclusions too. If investing in certain countries exposes them to nationalization risk based on European political decisions, maybe those investments aren't worth it. Shell publicly states they'll never invest in Russia again, but they're also cautious about China, Brazil, anywhere that might face sanctions. This caution means reduced investment, reduced future revenue, reduced shareholder returns. For European workers, this means job insecurity. When employers lose major markets and become cautious about expansion, growth slows, hiring slows, wages stagnate. The geopolitical dimension is even more concerning. Europe's strategy depended on economic coercion being effective. If that tool is damaged, what replaces it? Europe's military capacity is limited and fragmented. Diplomatic pressure works when backed by economic leverage. Without it, protests are ignored. China is the only unambiguous winner. Russian market share, UN as alternative currency, alternative financial infrastructure. And they demonstrated to the global south that partnership with China provides protection from Western financial coercion. The Belt and Road Initiative just got new life. China can now offer countries not just infrastructure investment, but financial independence from Western systems for nations that feel Western conditions are too intrusive. That's appealing. Russia's calculations throughout this were rational from their perspective. Yes, they lost $15 billion, but they demonstrated strength, damaged Western credibility, accelerated alternative system development, and imposed costs on European corporations that far exceeded their losses. From a purely strategic standpoint, they won the exchange, and they're not done. Russia has started hinting at additional retaliatory measures if European countries seize more Russian assets. What those measures might be isn't specified, but the threat is clear. Europe opened a door to economic warfare they can't control the consequences of. Some European policymakers are privately admitting the seizure was a mistake, not publicly. Public admission would be political suicide. But in closed meetings, they acknowledge the costs exceeded benefits. The problem is there's no way to reverse it. The assets are gone. The precedent is set. The damage is done. The only question now is how far the erosion of euro credibility goes. Best case scenario, it stabilizes at a new, lower level of trust. The euro remains a reserve currency, but a diminished one. Worst case scenario, this is the beginning of a spiral where reduced confidence leads to capital flight, leads to higher borrowing costs, leads to economic weakness, leads to more reduced confidence. The European Union was built on economic integration as a path to peace and prosperity. The irony is that weaponizing the very financial integration that was supposed to prevent conflict might end up destroying the prosperity that made integration possible. If European economies struggle because their financial systems lost credibility, the political stresses that follow could threaten the Union itself. We're watching the real-time demonstration of why financial systems depend on credibility above all else. The euro isn't backed by gold or commodities. It's backed by trust that European institutions will honor their obligations and protect your assets. When that trust is damaged, everything else falls apart. And Europe damaged that trust for $105 billion and 1 year of Ukraine funding. Historians will look back at this moment as a turning point, not because of what Europe did to Russia, but because of what Europe did to itself. And the lesson won't be lost on future generations studying how economic powers decline. They'll see a case study in strategic myopia, in political expediency overriding long-term thinking, in weaponizing systems you depend on for credibility. Russia taught Europe a lesson in economic warfare.